Today, we are very delighted to have a strong team that will be looking at an interesting issue of the interbank market in the East African banking sector or the East African banking region. First of all, I think it is in order to share with you a little bit of background of the studies that have been conducted over the last 10 years. And I think a good number of the people here in the audience have been involved in these studies of looking at the interbank market in Africa. The first set of papers on the interbank market in Africa were started by focusing on the interbank market in Kenya, and that's about 10 years ago. And that involved, and one of the initial co-authors is in the audience, Yi Bai, previous at the University of Nottingham, but now at Jiaotong Liverpool University in China, together with the Christopher Green at Loughborough and myself. So we got this huge grant from the World Bank, and together with the Central Bank of Kenya, and working with the then Governor, Professor Njuguna Ndungu, we conducted the first ever intensive study of the interbank market using with a highly disaggregated, highly micro data that was able to look into the market microstructure and also feed into the main policy dimensions, including monetary policy, including regulation, and also policy specifically to target the interbank market. And that was widely published. And that's the first set of papers, together with the colleagues at the Central Bank of Kenya, including Samuel Tiriongo, who is a co-author of this particular paper here. We started off those papers, and that gave birth to many publications, including journal papers, reports, manuals for training, and then started off with the second round of papers. Started with the ESRC project on delivering inclusive financial development and growth, funded by the ESRC and FCDO. That involved quite a number of countries, including Kenya, and Anika Mau got involved, and Moses Tiriongo, and this is where I also get Peter Wamalwa getting involved. So this team has been working on this before, but also involved interbank markets in other countries, especially in Zambia, with the Jonathan Kipimo, and also Malawi with the Esmie Kanyumbu, who is here and will be providing a discussion on the interbank market. She did quite the first set of comprehensive studies on Malawi. And also the interbank market in Uganda, in which Dr. Thomas Gwire, who is also here, got involved and produced quite a huge set of papers together with Martin Brownbridge. And all facilitated by Dr. Adam Mugume, who's also here, will be, discussant. So this work has expanded. What is different from all that work that I have explained this time is that for the first time ever, this paper gets together the number of East African countries. So it deals with the issues of cross-border interbank markets. It is novel because getting together the countries, Kenya, Tanzania, Rwanda, and Uganda together, getting a set of 5 countries, is a very important dimension of extending this work. And I want to thank, in particular, not only the authors, but also Dr. Thomas Gwire, who has been around talking about some of these ideas of how cross-border banking, cross-border interbank markets could play an important role in understanding where we are. This is Dr. Thomas Bwire from Bank of Uganda, but also from the COMESA Institute. And so this work extended that. The idea is to continue this work in new directions. A number of things have happened in the last, say, 5 years, which require new dimensions of understanding the interbank market. There are practitioners here who are also working seriously on, for example, payment systems across the Eastern African banking space. People like Grace Jokunda from the African Development Bank. And so I think we're going to have a very, very a good conversation. Fortunately, the speaker said he will speak for a very short time, and then we can have the discussion. So this is where we are starting from. Now, the speaker, the main presenter, Dr. Peter Wamalwa, is a well-seasoned, very accomplished researcher, a highly mathematical genius. I remember his a PhD at Cape Town University, which I was very lucky to get involved in the end in the examination process. Highly impressive and highly mathematical way of capturing, monetary policy. And of course, a very active researcher within the African Economic Research Consortium, or the ERC. And Peter has established himself in looking at financial issues, monetary policy issues, especially with the in the most of the African dimension. Has a background in academia, has been a lecturer at Maseno University, before joining the Central Bank of Kenya. The authors, the co-authors with Peter, are also highly accomplished researchers, and the authors include the Captas Chironga. Captas Chironga has done a fantastic piece recently in the book of a central bank in Kenya for 50 years, which I co-authored with the governor, Patrick Njoroge. Captas Chironga has a very, very interesting chapter in that book. And also in that book, also another chapter from Anne Kamau, who is also an accomplished researcher, having worked at international organizations and also at Central Bank of Kenya. And Samuel Tiriongo, who, as I mentioned, was in the first set of papers 10 years ago. Samuel was serving the Monetary Policy Committee of the Central Bank of Kenya, and then actively took off and even wrote so many papers under the African Economic Research Consortium. So this is a very strong group that came together to produce this first ever paper that brings the East African interbank market into focus. We're also fortunate today to have a group of eminent discussants. Each will speak for about 5 minutes, maybe 5 to 10, concisely to comment on this paper, either in the academic sense of commenting on the academic content of the paper, but also on the policy dimension, and also maybe on what future research should look into. We have here Dr. Adam Mugume, who is the Executive Director for Research and Policy Directorate at the Bank of Kenya, at the Bank of Uganda, a seasoned researcher since his days at with a PhD at the University of Oxford, and has produced quite a lot of influential papers, not only in Uganda, but on broadly in the area of monetary policy. And then we also get comments from Dr. Patrick Hitayezu, who is the Director of Research Department at the National Bank of Rwanda, and also a very active researcher, highly mathematical and producing very interesting pieces, very active and very, very super fast in producing prolific work. And then we also get some discussion from Yi Bai, who is an associate professor in finance at the Xi'an Jiaotong Liverpool University in China, and was in the first set 10 years ago of looking into interbank market, doing field works in Nairobi with Chris Green and myself. And then we also have comments from Esmie Kanyumbu, who is a senior analyst in the financial markets department at the Central Bank of Malawi, the Reserve Bank of Malawi, and is also completing her PhD at Loughborough University. And also get comments from Sherillyn Raga, who is a senior research officer at ODI London, and recently presented a very interesting work here on the interbank market together with Judith Tyson. Good to see you again here, Sherillyn. And then we also get comments from Anosi Ikimimalo, who is about to defend his PhD thesis at SOAS on the interbank market. Okay, so this is the program. I'll stop here and have the pleasure of inviting you, Peter, to start the presentation. Thank you.
Thanks, Professor, for the introduction, and I'm grateful for you having given us this opportunity to open up this discussion in a written form on the issues of interbank market and systemic risk from the perspective of cross-country, and this is quite good for us and very exciting, and we are really grateful for this. So I'll go straight to the presentation so that we open up the discussion for this. So this is the presentation outline. We'll have motivation, objectives, and methodology and results, and then we'll end up with conclusions. So, well, we start with from the point of view that financial services are, as a result of the flow of underlying economic activity. And in the EAC, there is increase in trade integration, and that has resulted to commensurate demand for financial services and across the borders of EAC. And EAC consists of Kenya, Uganda, Tanzania, Burundi, Rwanda, and South Sudan. So the countries here that have integrated intensively are Kenya, Uganda, Tanzania, Burundi, and Rwanda. So with the pickup of economic activities across the countries, it has enabled financial services to equally increase. This has made financial service providers, especially banks, to intensify operations across borders, and this has strengthened linkages among banks in the EAC. But more importantly, regional interbank linkages have been reinforced by economic structures of EAC countries. As you all know, EAC countries are predominantly agricultural. They depend on manufacturing, and the centers of manufacturing activities are located in Kenya, some in Uganda, and some in Tanzania. And also transport hubs are located in Tanzania and also in Kenya. As a result of these economic activities, the supporting financial services have created interlinkages in this region. So in particular, the dominance of agriculture, mining, and manufacturing activities in these economies and having subsidiaries across countries have enabled banks also to leverage on these economic activities in the real sector to provide financial services. The similarities in economic activities have also influenced portfolio composition of assets and liabilities. So for instance, the composition of sectoral loans, they mirror, or they have been increasing or fluctuating in tandem with economic activities. And also the quality of assets, we shall show you in a moment that if impairment in economic activities occur, then non-performing loans also follow suit. And also the structural problems that exist in terms of fiscal deficits, also which have been financed by most of these banks, they necessitate that banks allocate significant amount of their portfolio of assets in government securities. So there is also concentration of deposits, and these patterns are replicated across the regions. So the financial interlinkages that exist, as well as homogeneity of assets and liabilities, they accentuate systemic risks in the interbank market and the banking sector. And this is premised on the fact that banks, whenever they are not able to source funds in the fundings to fund their assets from deposits, they have to come to the interbank market to bridge liquidity gaps. And once they get liquidity, they lend to the real sector. So as a result of this, there is financial interlinkages from the interbank market to the banking sector, and then finally in the real economies. But now, the fluctuations of these real activities, as well as changes in the liquidity in the financial sector, develop systemic risks in the interbank market and also in the banking sector. But now, but the extant evidence on the issue of how financial linkages and homogeneity of assets affect systemic risk is incoherent, because first, there's a branch of literature that says financial linkages, whenever they are robust, there is minimal liquidity, there's minimal systemic risk, or systemic risk is. The issue at hand here is the role of financial linkages on and its impact on systemic risk. So the existing literature is incoherent with respect to the impact of financial linkages on systemic risk. On the one hand, say that the robust financial linkages betrays the financial banking sector and insulate it from systemic risk. On the other hand, the literature negates. Then the second issue is about heterogeneity of assets and systemic risk. The existing literature supposes that, there is evidence that if assets are heterogeneous, there is likelihood of what we call sunspot risks, because there is, if the assets are heterogeneous in terms of maturity profile, in terms of borrowers and so forth, it is highly unlikely that systemic risk will be evolving. But however, if assets are heterogeneous, it's more likely that the size of the financial institution is large, but these interlinkages that as a result of large financial institutions, they are so robust such that it is vulnerable, the financial institution is vulnerable to risks. And if a large financial institutions develops problems, then a large proportion of the sector or a large segment of the sector will be impacted. So from this incoherence in the existing literature on the impact of heterogeneity of assets and systemic risk, we seek to analyze the effect of the diversity of these assets on the systemic risk. So so in this case, in this paper, we try to analyze, first of all, the architecture of the banking sector, interconnectedness, and its impact on systemic risk in the ESC. And in the architecture here, we mean the structure of the existing interlinkages in the interbank market, which is a melting pot for the banking sector, and how that elevates a contagion risk, first of all, and then systemic risk in the ESC, given the interlinkages that exist. So in particular, we first want to establish the architecture of national interbank markets. And then secondly, we proceed and then look at the interlinkages that exist in the ESC. Then, after we've done this, then we go ahead and then analyze heterogeneity of assets in order to assess idiosyncratic and common risk exposures of banks in the ESC. So we focus generally on the ESC because, first of all, in the ESC, we have banks that are domestic, we have multinational corporations, and also we have banks incorporated in the ESC countries but have cross-border operations. And these provides us with a rich data set, as well as somehow like a natural experiment for us to assess the architecture and its contribution to systemic risks. So domestic banks in each of the EAC state has the largest market share, and this is followed by multinational corporations and banks incorporated in the EAC, especially in Kenya. So amongst these three categories of banks, so the domestic banks in each of the member states, first of all, have a large market share within country. And then they are followed by multinational corporations, and then banks that are incorporated in the EAC, and especially in Kenya. So to just elaborate on this is that we target banks, for example, in Kenya Commercial Bank, and in Uganda it is Centenary, and and so forth in Rwanda, because these banks are large domestically, and certainly they have an impact on the risks that emanate from the activities in the interbank market, and in the interbank market first, and secondly in the banking sector, and thirdly in the economy. To elaborate on this structure is that the banking sector in Kenya is the largest in terms of size and number of banks, and it has the largest subsidiary in the EAC, followed by banks incorporated in South Africa and Nigeria. So then in terms of assets, the loans and advances for the entire banking sector in the EAC region account for 70%, while government securities 25%, and about 5% account for placements and investment. See, the dominant issue here is loans and advances consist of a majority of the share. Let's say it's a large share, a large proportion of the assets, followed by government securities and so forth. So, and then lending, in terms of patterns, is concentrated in government securities, real estate, and household. They account more than 50% of the loan portfolio. These are about 4 sectors, yet economic sectors are about 11 of them. So out of 4 sectors which account for 60%, about 8 of them account for 50%. But the sectors here that we mentioned, that in which loans are concentrated, have strong backward and forward linkages, and therefore, if there is an economic shock in these sectors, then the banking sector will be affected. So this is kind of a common exposure in this sense. So the interbank market has significantly developed since 2010 to 2020, in a span of 10 years. The value of lending increased from 5 to 9%, doubling.
You come off
Sorry?
the way you entered.
Okay. So I'm sorry about. So then the interbank market, the transactions are segmented in terms of by size, the origins and assets of banks. Then there is a segment. You see, the interbank market is segmented into 2: collateralized and non-collateralized lending. So collateral consists of government securities, and these were introduced to deepen the interbank market, but it hasn't deepened. Actually, the collateralized segment of the interbank market consists of about 2 to 5% of the interbank market, which means that about 98 to 95% is non-collateralized. So, but still, there is persistent segmentation, which has accentuated liquidity or inefficiencies in the interbank market. And secondly, despite there being collateral, there are huge haircuts of about 20% on the interbank loans. So in this segmentation, there is tendency to trade within the segment in an effort to reduce a counterparty risk. But this is only inefficient because the banks not only get liquidity from within the segment, but also the liquidity could be expensive. This is because there is bifurcation. Okay, there is increased the fragmentation within the segment means that the trade within the segment is binding, and because of the existing relationship among financial institutions or banks, so they are not getting liquidity from banks that have excess liquidity, but simply from banks that have that are in the segment and have credit lines with them, or they are known to them, but that's efficient. So because of the difficulties in terms of redistributing liquidity among banks, banks tend to ensure themselves by holding excess liquidity, and this is inefficient given that it's expensive to hold liquidity. For example, some ESC member states, liquid assets account for about 50 to 60% of total assets, while they could earn profit by lending these and rely on the interbank market to smoothen fluctuations in liquidity. So, despite the policies to increase, to deepen and increase efficiency of the interbank market, there's still persistent interbank market fragmentation and unequal distribution of liquidity in the interbank market. And this has consequences in terms of private sector lending, transmission of monetary policy, and also financial inclusion. Then there is also financial interlinkages have increased tremendously within ESC, and also within member states and within the ESC. But this is also elevating liquidity risk. So you see, the persistence of segmentation amid increase in financial linkages warrants us to analyze the contribution of these financial linkages and the heterogeneity of assets on this. So, if we an inspection of the literature is also incoherent in this case. That first of all, the issue of whether fragmentation is good and also the existing financial linkages is good in terms of limiting counterparty risk, and as a result, contagion risk is out here, but they're also divergent of it. So, first of all, a fragmented interbank market has few complete financial linkages, which limit the spread of counterparty risk, which can evolve into systemic risk. So, in this case, the literature on this line presupposes that fragmentation is will exist, and this is quite common. For example, the existing literature from Brazil, and all over in the nation says that the core periphery issue or phenomena has to exist, and sometimes is efficient and also underpins financial stability. However, complete networks reduce risk incidence and systemic risk to banks because exposure is shared among banks. So if there is a dense interbank network, which means each bank is connected to all the other banks, there is co-share, and actually the exposure of each bank to the other in terms of counterparty and liquidity risk is very low. However, this doesn't exist. Interbank markets are characterized by this. So then immediately we follow on the complete network is the issue of existence of shocks. So if the network is complete in the interbank market, and shocks are not idiosyncratic, the resilience of banks will have to depend on the diversity of assets and liabilities. So there is another debate that despite the fact that exposure is limited in terms of if the network is dense, however, in the event that there's a common shock, then the entire banking system is susceptible to systemic shock. Then it's only the diversity of assets that can ameliorate the situation. So the diversity of these assets is important. However, the diversity of assets comes with the size, as we have alluded earlier, and also other extensive interlinkages, which also is on risk. And more importantly, cross-border interlinkages have become very important in terms of propagating systemic risk. And this is quite important in the EAC, given that these economies are interlinked. The owners of banks in Kenya are the same owners of banks in Uganda and so forth. So the intensity of cross-border linkages have become more prominent, and as a result, there are systemic risks. So this paper tries to shed some light and also on the issue of whether these interlinkages, first of all, do exist, and if they exist, what are the drivers? First of all, what is the contribution of heterogeneity of assets to systemic risk, and whether they impact systemic risk. So, in order to analyze these two issues, we look at first of all, we try to look at the interlinkages in the interbank market. We apply the network analysis method. And secondly, we apply the machine learning technique, which is latent Dirichlet allocation by Blay and others in 2003, to identify commonality in the data and underlying relationship among banks. This is motivated by the fact that it's not easy to find a data or cross-border, for example, cross-border interbank lending or cross-border interbank loans. Therefore, we have to rely on the structure of the balance sheet and the income statement to draw commonality or correlations among these items so that we examine the common exposures. So once we have traced these common exposures, we look at how these common exposures elevate systemic risk. And we measure the systemic risk, first of all, using marginal expected shortfall of the interbank transactions. So what we compute is, first of all, the marginal expected shortfall is computed from a interbank amount that is lent. So then we compute, first of all, value at risk, which we then the Z score for this, then compute the value at risk and the marginal expected shortfall for each bank. The importance of marginal expected shortfall is that it will tell us the contribution of each bank to systemic risk. So if a bank defaults, that is a systemic risk, because evidence has shown that whenever there is a default in the interbank market, it dries up, and as a result of lack of interbank lending, private sector credit declines. We saw the issues of the 2015 in Kenya, and also the precursor to Kenyan case was the global financial crisis that started in the US, and it spread over to Europe, because the main market that was affected was the interbank market. So the drivers of this systemic risk are investigated next by estimating a simple model of drivers of systemic risk, which is a fixed effect model, because we have bank level data, so that we conduct this regression. So first of all, starting with this, we have to draw the architecture of the interbank market, and this is described by the network methodology. From these results, which are computed from bank level data for quite some time. So we find that from this, we draw the degree, which is just like the number of transactions. In this, the average number of transactions per month, out degree, and betweenness. So from what we look at this, from what we gather from these results, that segmentation is segmentation is high in Burundi and low in Kenya. In summary, because to designate as a market being more segmented, we look at these metrics: the degree, out degree, betweenness, centrality, and the diameter, as well as the density. So from this, that Burundi is the most segmented, and Kenya is the least segmented market. So the consequences of this is that whenever there's segmentation, counterparty risks are minimized, but liquidity risk is very high because it's not possible to get liquidity efficiently from wherever it is, and therefore there is tendency to intervene into the market. So from here, the existence of segmentation in the interbank market is underpinned by the structure of the balance sheet. So the next thing we need to look at is whether the balance sheet or the balance sheet of these financial institutions in various jurisdictions are similar, and what are the commonalities in this balance sheet structure. So so this is just a summary. So the regional linkages here, in summary, the full results in the paper, and here I provide only a summary by saying that the regional link is provided by Pan-African banks such as KE, SBK, KE, Bank of Baroda. So, by the way, see, if a bank starts with KE, these are Kenyan banks. If it starts with T, T is for Tanzania, Burundi, Uganda, and Rwanda. Of course, you see this data is anonymized because for confidentiality reasons. So we use these pseudonyms so that we try to confine to know they are coded so that they can remain anonymous. So the linkages are provided by these prominent banks, and some of the banks from the rich data set that we have is that it's predominantly provided by banks in Kenya and banks in Tanzania and also Burundi, Rwanda, and Rwanda. So the common characteristic among these banks is that they are Pan-African banks, whether they are established in Kenya, Tanzania, and Uganda or Rwanda. They have Pan-African orientation in the sense that they have subsidiaries in other EAC member states. So now, when we look at the correlation among these, which determines the exposure of banks in this region, is that if we look at the national level, the banks are quite large because they account for a large proportion of the banking sector. And then when it comes to the EAC, for example, for banks in Burundi, they have least commonality with the interbank market. So the conclusion here is that if the correlation in this column for interbank, for the balance sheet and the income statement was 0, then there will be no interlinkages, or the balance sheet will not be correlated or income statement. But since the correlations are high, it shows that these banks are interlinked, and one of the interlinkages is provided by subsidiaries and also some of the cross-border operations or establishments. So the existence of these cross-border strong interlinkages in the balance sheet as well as the income statement predisposes them to common shocks in the region. For example, economic outcomes, administrative policies that may curtail some of the economic activities. So, although this from the paper, we can see that the banks that are on the same tree have strong interlinkages, and of course, we see that they are segmented into 5 branches according to the national states, to the national the jurisdiction. But by the fact that there are linkages here, it means that they are cross-border interlinkages, and these financial institutions have relationship that do exist. So this is the balance sheet. But then when it comes to the main issue that we believe underpins this is that their portfolio allocation in terms of sectoral distribution of their loans, we see that there are even stronger interlinkages among these banks, because the edges, the lines that joins the dots here, of course, the red balls are the nodes which represent the sectors, and the thickness of the edges or the lines here are the intensity of the relationship or the interlinkages in this case, because we're using machine learning at the intensity or the level of correlations. So by the fact that the portfolio location of this loan of this of the banking sector and the ESE is more or less the same, then they have common exposures through sectoral lending. So the next thing that we need to analyze is the contribution of the systemic risk the contribution of systemic risk as underpinned by heterogeneity of assets. So in this case, what we do, as alluded earlier, is that we compute the value at risk first of all from the interbank lending, then we compute the Z-score also, and we test this Z-score against marginal expected shortfall. And the thinking is that in the event of a default, how much value is at risk as contributed by each and every bank this, because we have bank level data, and also this is the dependent variable is marginal expected shortfall from the interbank lending. So from this regression, from the Z-score, we see that heterogeneity of assets is negatively related to the Z-score, but when it comes to the marginal expected shortfall, is positively related. So which means that a decline in the heterogeneity of assets increases systemic risk. So of course, there are other factors that could contribute to systemic risk in this, and these are robust growth and lending policies. So in column 4 is that these are domestic banks. So in column 3, these are entire set of the banks. Then in column 4, we just take out the domestic banks. So the domestic banks, which means that these are banks that are only in the ESE, but they don't have cross-border branches or subsidiaries. So here is that the heterogeneity of assets, decline heterogeneity of assets increases systemic risk. So the coefficient is not quite different from the pooled sample of all this. Then in the regression 5, we take out Kenyan banks with Pan-African orientation. So these are banks that are established in Kenya, but have cross-border operations in all the ESE. So we're looking at banks that were established in Kenya, that have origins, that have operated for over 100 years in Kenya, or 60 years. They are large in Kenya, but have branches or subsidiaries in Uganda. So this is the sample size. These are 5 banks. These are 6 banks. And the heterogeneity of assets contributes significantly to systemic risks. So the coefficient is even larger when you look at the last pool of results, which are South African, Nigerian, Pan-African banks that have a presence in Kenya and in the ESE generally. So heterogeneity of assets contributes to about 0.58%, which is the largest coefficient. So the issue or the main results here is this, that the interlinkages that have been established over there, they could increase the level of systemic risk if they are underpinned by a decline in heterogeneity of assets. That means that if assets are homogeneous in terms of the balance sheet, this, by the way, heterogeneity of assets, just Hitchman and Huffington index, which we use to capture heterogeneity. So what we can conclude from this paper and the main results is that the interbank market is segmented in Burundi compared to Kenya, Tanzania, Uganda, which reduces susceptibility to the contagion risk in Burundi, but liquidity risk will be high. The linkages among banks in the region are anchored on the similarities in assets and liabilities and concentration of loans to trade, manufacturing, transport, and communication, which elevate systemic risk. Then Pan-African Kenyan banks and Pan-African South African Nigerian banks provide linkages in the ESE. However, their assets are not heterogeneous, which increase systemic risk. As we have seen that the coefficient, when we take out the sample, we discover that the coefficient on the heterogeneity of assets is very high. And the policy implication of this is that deepening the interbank market so that it can grow in terms of volume and size, and encouraging diversification of assets and liabilities will reduce systemic risk into this, because the interlinkages are growing obviously over time, and the only way to mitigate systemic risks in the interbank market and encourage growth of the interbank market is to encourage systemic risk. So thank you so much for listening to me. Yeah.
Well, let me thank you, Peter. Why do I have an echo? Let me thank you, Peter, for an absolutely exciting, interesting presentation, and for the good structure, I say excellent structure for this presentation. You really very well combed the existing literature relevant to the issue of the interbank market, but also took the time to explain the structure, the banking structure in the 5 Eastern African countries. And that provided an excellent background of this work. And also explanation of the methodologies and the innovation as you made in actually doing the empirical work. And then the interesting findings that you finally shared with us. It was interesting to see that the Pan-African banks are playing an important role in this setting. In particular, the Pan-African banks originating from Kenya, Pan-African banks originating from Nigeria, and Pan-African banks originating from South Africa. But perhaps we'll see whether the other source of Pan-African banks is, of course, Morocco, but it's not clear whether the Moroccan banks are playing an important role in the Eastern African region. So interesting paper, very excellent methodology, and also interesting findings. Now, possibly let me see whether your co-authors have anything to add. So, Capitas Chilonga, who is here, Anne Kamau or Samuel Turiongo. If you have something to add, please do so now. Or if you want to come in after the discussants, that's also perfectly fine. Okay, I see a hand up from Capitas. Capitas Chilonga, please go ahead.
Yeah, thank you, Professor. And let me put on my video.
Thank you.
Yes, we are.
Yes, I did introduce you. I did introduce you earlier, and especially your fantastic chapter contribution, the CBK book. So brilliant
thank you.
Piece.
Yeah, thank you, Professor. Now, let me just highlight one or two issues on liquidity in the interbank market from our paper. One of the issues we find is there's a lot of efforts which have gone, which have been put in place to deepen the interbank market, particularly the collateralized market, or what we call the horizontal repo. And I know the ESC under the Monetary Affairs Committee has had a number of discussions and even a project to ensure that this particular market grows so that we can, as much as possible, to reduce fragmentation, not only at national level, but at the ESC level. But from our paper, we still see very large haircuts, particularly on the government bonds, which are mainly used as a collateral. Most of them are 20%. And in fact, even non-government bonds or even subnational bonds are not even used for collateral in the first place. So the question is, why? What is the issue? Why are we more than 5 or even 10 years, we are still talking about underdeveloped collateralized interbank market? Perhaps we don't know whether perhaps some of the people in the audience might have a view. But when you look at most of these East African banks, we've taken the Global Master Purchase Agreement to be signed among banks as a guiding principle on which the interbank collateral interbank market can actually function. But still, special banks, global banks operating within the region, feel that the aspect of the resolution in the event that one bank has lent to another one and the borrower actually goes under, it will be quite difficult for the lender to realize the security. So that has made it quite difficult to deepen the horizontal repo market or the interbank market within the ESE, leaving where it's working, for example, in Kenya, or pockets of collateral interbank, you find that the spreads are quite high and the haircuts on securities are quite high. So maybe for researchers, we need to go deeper and see what we can do to make sure that we actually deepen this market, because it's really affecting the distribution and effective management of liquidity. Perhaps when Peter was introducing, we said Southern Sudan is also a member of ESE, but I think we have issues of data limitations, which made it quite difficult to incorporate South Sudan. So those are just some of the things I wanted to highlight. Thank you.
Thank you, Capitas. Very, very interesting addition and very helpful. And indeed, we can only hypothesize based on these results how South Sudan will evolve. And maybe with the passage of time, we could be able to get data for the extension of this work for the time being. Okay. I'm sure that Dr. Anne Kamau and Dr. Samuel Tiriongo will come in the discussions to follow out. Samuel, you have your hand up. Please go ahead. As I introduced earlier, Dr. Samuel Tiriongo is one of the original set of groups that started working on the interbank market in Africa. From his time at the CBK and the Monetary Policy Committee, is now with the Kenya Bankers Association. Please go ahead.
Thank you, Prof, and thank you for the opportunity once again to really discuss matters interbank market, and maybe just to add a dimension to what my colleagues Peter and Capitas have said, is really within the EAC region. Of course, there is an intention to integrate them all. There is an intention to build one market for all. And of course, behind the scenes, there is harmonization of policies. So even as we talk about systemic risk at the regional level, the work really would be very important in informing some of the regional policies to be adopted across the regional markets. So when you talk about the correlations in balance sheets, in income statements across the banking sector, it's really a reflection of some of the already integration that the markets have actually acquired to a certain degree. And even as we move into proposing policies for the regional markets, I think the results is going definitely to inform these policies, and even the expansion plans for our banking sectors, because as Peter did mention in the beginning, that some of the banks are spreading their wings into the region, and of course soon we may start seeing some of the Ugandan banks spreading into Kenya, and now and vice versa. So even the strategies that banks would be adopting, because I think in finance we all agree the benefits of diversification. But now that we are opening up the market to a wider market, it becomes very interesting also to look at, are we exposed to the same sort of risks, or now we are differentiating our risks going forward? So it's of greater interest, and more so even within this space of fixed effects model, our interest more would also be in terms of some of the within country specific uniquenesses, because we also acknowledge that we are at different levels of development in our interbank markets. And for instance, in terms of the pricing frameworks in Uganda is completely different from the pricing framework in Kenya, and so it is in Tanzania and other countries. So it would also be interesting for us, even as we think about next steps for this paper and writing, is really to bring out the within country specific effects, particularly the differences across the policy spaces and market infrastructure within these countries, even as we enrich our discussions going forward. So thank you. Maybe we'll come back later with reactions.
Thank you, Samuel. Very much appreciated. Interesting points, all of these, and ending up with a critical issue of infrastructure. Maybe Grace from FDB will possibly comment on this when we come to question time, because that's an interesting issue of synchronization of the payment system to promote a cross-border trade. The empirical measures you have generated will be able to do that. They'll even be able to measure the speed of cross-border banking flows through the interbank market. So let's now go to the discussants. We are fortunate today to have a high caliber group of discussants. And the first one will be Dr. Adam Mugume. Dr. Adam Mugume holds a PhD from the University of Oxford and has worked both in academia at Makerere University and within the ERC Research Consortium training for PhD scholars. But the most important aspect, what Adam brings into this discussion, is his magisterial knowledge of the banking structures, both in Uganda and the East African region. And indeed, over many years, he has presided over the monetary policy projections and the policy announcements in Uganda, but also commenting on the East African scene. So, Adam, you are most welcome. Please go ahead and start your intervention.
Thank you, Prof, for inviting me. And I agree with you that this has been one of the most well-researched piece of work, bringing out clearly some of the issues we have been grappling with within the region. One, on market segmentation, has been one issue that has really, challenged us in the policy making. The other aspect is the fact that even with all interventions, the horizontal repos are yet to take. And I think those are some of the aspects that really, come to the fore in terms of appreciating the piece of work that we have just had a chance to look at. So overall, I agree with the findings in the sense that actually, yes, like, for example, when we say the size of the bank and its ability to do the interbank, we see it really, that is the norm. We see that big banks, they have really, diversified kind of assets and liabilities, and therefore they're able to play in the interbank market very easily. Now, for smaller banks that are starting, their assets and liabilities are really concentrated, and therefore they are unable even to be able to expose themselves into some of these new developments like the interbank. For example, like in the case of Uganda, we rarely see small banks or the new banks that have started going into the interbank. When actually look at the volumes of the interbank, you are talking about big boys. Those are the ones that really dominate the interbank market. to a large extent. So I agree with the aspects of asset and liability, concentration, and therefore the size of the banking. I liked what I think the last presenter mentioned, that actually what we see is that there is some within the country setting that actually, that was one my first point, that actually once you aggregate the banking system in East Africa, you lose out a lot of details. We all know that, yes, the banking system in Kenya is quite strong compared to the East African region. There's no doubt about that. And the dynamics, the way they play in the Kenyan market is different from Ugandan side. For example, if you tell me the Ugandan market, I know that these international banks, the corporates, I think the presenter mentioned the corporates really dominate the the interbank arena. We have started seeing the new entrants like Centenary Road Development Bank coming in the case of Uganda, because now it is the third largest bank in Uganda. But largely, when we're talking about these international banks, the way they trade, the way the rates they give them each other are really, very low compared to what we normally see in the other aspect. Actually, in the case of Uganda, we normally categorize the interbank into 3 categories: large banks vis-a-vis large banks, and we look at the rates. Then we start looking at the way medium-sized banks, the way they trade themselves, and also the small banks, and then also see how big bank trade with the small bank, and vis-a-vis how a small bank would be lending to a large bank, what are the rates, vis-a-vis what a large bank would be lending to a small bank, and we see the pricing mechanism. And we normally, probably what is not coming out in the discussion is behind the scene, regulators are also observing and calling each bank. If we see a big bank trading outside the range with another bank, we have to call the bank and say, oh, hold on, what is going on? Can we justify your pricing mechanism? And so some of those measures the regulators put in place actually do to somehow do play a part in the pricing mechanism. So I think that is really an important aspect. And the other aspect probably that didn't come out too clearly in the paper is that actually the banks, the way we see them at least in Uganda, they have what they call limits. Each bank puts a limit to the other. So you might find that a bank has a lot of liquidity. Another bank A has need of liquidity. But because of the limits, the bank with excess liquidity can't give the bank with need of liquidity. To the extent that even some of the banks put heavy limits on the central bank because of the risk aspect, etc. So there are some of those measures that are behind the transaction that probably never came out clearly in the paper. Now, there is also aspect which there is a role for regulators, in the sense that there are some of the regulatory mechanisms we put in place that could actually be enhancing excess liquidity holding by banks, rather than the fact that they cannot do the interbank. So there is that aspect that actually, when we talk about guidelines in terms of how much liquidity each bank is supposed to hold, mainly so if it is a systematically important bank, they have particular liquidity buffers they are supposed to hold at any given time. So there is a role played by the regulators behind the scene in terms of actually seeing what we see, that actually banks do hold a lot of unnecessary liquidity, not because of the interbank involvement, but also because of some of the aspects of the regulations. Now, another aspect that I know it might be off the paper is the aspect of the swap development. We see that actually in swaps, like in the case of Uganda, are becoming more dominant compared to interbank lending. Our interbank lending, it has no collateral. It is basically, it is non-collateralized. But the swaps, by nature, they have inherent, collateral. So we see a lot of banks going into the swap, actually, compared to the interbank. And it could be, for example, when you're talking about KCB in KCB Nairobi and KCB Uganda, you would see, you could expect a lot of swap going on between the KCB and Equity Bank, because these are, they are closely related. The same story with Standard Bank. Standard Bank South Africa, whether Standard Bank Tanzania with Standard Bank Uganda, they have a lot of swap transactions going on, rather than going into the interbank. Because the interbank, the argument is that the interbank is limited. The other swap is unlimited. So long as you have a deposit and you have, a forex, which is the collateral, actually it is more vibrant now than in the interbank. So that aspect of the swap and the interbank is another aspect. Probably it could be beyond the paper, but it's something that probably need to highlight on. Finally, I think the paper missed out something that actually within the East Africa, the central bank governors have really taken steps to do market integration. So some of the that we are talking about in terms of, a systematic risk aspect, etc., is because of in what the central banks have put in place, like harmonization of regulatory frameworks, cross-border supervision frameworks, etc. Some of those aspects actually, and they have really enhanced the financial sector integration within East Africa. You are talking about East African payment system that is in place. All those measures undertaken by the central bank governors are really driving the integration in the financial system, and probably that needs also needs to be recognized. Those are my few comments. Thank you again for inviting me. Back to you.
Oh, thank you, Adam. Extremely helpful, excellent interventions. And there are many points that you made which should have to go into the paper in one way or the other. And some of them for even proposing work for extending this work. For example, you mentioned the swaps, which have underlying assets compared to the interbank market in which there is no collateral. And that's a way of research that would look at developments in the interbank market and the new competition that arises from swap transactions, especially with the cross-border banks that are coming from have the same family headquarters. So, thanks indeed for these points and the contributions. So I will now call upon Dr. Patrick Hitayezu, and Dr. Patrick Hitayezu is the director of the research department at the National Bank of Rwanda, and a very, very prolific researcher. And I've seen some of his econometric work, absolutely interesting. So Patrick, you have the floor.
Yes, thank you so much, Professor, for such a great opportunity to participate in this discussion, to look at the paper that really touches on such topical issues in contemporary financial economics. So my observations and discussions are going to revolve more around the framing of the role of central bank policy actions, as well as broader sustainable development policies. But before going into that, let me mention that I found the methodology to be very sound and the results are quite insightful. However, cognizant of the vibrant nature of EAC economies, I wonder whether the relationships that have been demonstrated in this paper have been really stable over time. I think the analysis would have been more informative if they had shown the dynamics in times, especially for younger and evolving interbank markets. In Rwanda, for example, one of our studies had shown that there's an increasing trend in both network density and degree, indicating some level of completeness of the interbank market over the last 10 years. So it would have been interesting to look at other countries also in that dynamic perspective. Are we seeing the same trend? Are we seeing the markets to get more fragmented in some economies and more sort of disaggregated in others? Still talking about the time factor, as it stands now, the paper has mainly focused on the history, the backward-looking approach, but we really want to understand more of the trend in the coming 10 years or so, based on some reasonable and foreseeable assumptions. What can we expect? Should we expect an increased regional interbank connectedness, as my colleague Dr. Mugume was saying? What can we advise based on that? Should we put in place a framework for cross-border bank supervision and regulation? Those type of questions can significantly add some information for policymakers. Now, coming back to the policies, especially central bank policies, I'm just going to mention a few things that the Central Bank of Rwanda has done to observe what has been mentioned in this paper, like a 531 percentage points increase in interbank transaction from 2013 to 2019. So what did we do exactly? Some of them were mentioned in the paper, but there were some that were specific to the Central Bank of Rwanda. For example, we participated in very aggressive capacity building for treasurers. Currently, most of them, if not all of them, are ACI certified. We engaged banks in dialogues to build trust through our regular meetings with them. And probably in Rwanda, unlike in many other financial economies in the region, all our interbank transactions are currently collateralized. We have now implemented a true repo, the repurchase agreement pledged as collateral. We've automated most of the infrastructures. Now the CSD and the RIPS, the Rwanda Integrated Payments Processing System, is live 24, and we have also automated the intraday liquidity facility, etc. We even plan to extend the true repo agreement to non-bank financial institutions. And what have been the result of that? We've seen decreased information asymmetry and increased interconnectedness, which has significantly reduced the counterparty risk, as shown by decreased liquidity above the required ratios. We've also seen a reduced segmentation that has been curtailing the distribution of liquidity in the interbank market. And we've also seen a very stable interbank rate and increased volume of transactions. So now this paper also touched on indirect channels of the risk to the stability of the financial system by looking at similarities in balance sheet and income statements. And usually when discussing about such issues, it is very, very important to recognize the important role that broader development or sustainable development policies have played, mainly on the demand side. Specifically, we need to recognize the role of structural transformation programs over the last decades. Taking forward the findings of this study, the risk assessment points to the necessity to review these programs in light of the findings. Specifically, there are questions that would arise, such as how do you de-risk the agriculture so that it becomes attractive to the financial sector. So currently in Rwanda, we are devising major programs that are aimed at risk sharing and the financing of the agricultural sector, the kind of programs that are already there in Nigeria and Ghana and in such countries. Recently, our banking sector has started to venture into the manufacturing sector that was that traditionally accounted for lower share in our bank loan books. There's also a heightened need to review the financing of the mining sector, which is currently problematic. And it is also important to mention that penetration or access of these sectors to the financial sector would also increase macro financial linkages that are critical also for monetary policy. So with that said, there is need to review the objectives of our central banks to include more of a sustainable development objective, which could help to achieve other objectives of the central bank, like financial stability that we are talking about here. What we have done in Rwanda is that our central bank has recently introduced in its structure a department of financial sector development that has that function of reviewing policies and anything that the central bank could do to support broader sustainable development policies, whether they are related to the financial sector directly or even outside the financial sector. We even currently talking about climate change policies. So those were my comments, but maybe on a different and closely related note, there has been some fledgling debates around development of an interbank forex market. It will be interesting to hear from the author's perspective what they think about that. We know, of course, that most of our banks are in negative NOPs, but we are thinking of making our forex rates to be more market driven, and it will be interesting to understand the author's view about such a facility. So those were my comments. And again, thank you so much for giving me such an interesting opportunity to participate. Thank you.
Thank you, Patrick. Very valuable comments and feedback on the paper, and also for sharing experiences of developments at the Central Bank of Rwanda. And as well, posing a question that I guess we'll come back to about the interbank forex market idea. So, thank you very much. We now call upon the other discussants, and maybe if I could ask that they stick to the 5 minutes. So I call them in this order: Yebai, after that Esmie Kanyumbu, and then after that Sherillyn Raga, and then Anosi Ikimimalo. So Yebai, Associate Professor in Finance, Jiaotong, Liverpool University, previously at the University of Nottingham. Yi.
Thank you, Victor. Thank you very much for giving me this really great opportunity and the privilege to discuss this really interesting paper. When you mentioned our last work or trip to Kenya, that's 10 years ago, yeah, I didn't realize it's been that long. Time definitely flies, and it's really great to see all the friends and colleagues like Samuel here. Although it has been this long since we start, looking at the interbank market, but the importance and the usefulness of the research question, it's actually not fading away, but actually getting more important. And clearly we can tell by listening to this very interesting presentation. So given the importance and the rich data set used in this particular study, my comments are really it's actually rather comments, or rather say it's more for questions, because it's such a thought-provoking research and a very important research question. I totally agree with what Victor just mentioned. This is a very important and interesting topic, and the paper provided a very comprehensive view from the insider's perspective, giving us a lot of useful information about the major EAC banking sector and the development of their interbank market. In particular, they have used very interesting and new approach, such as the machine learning technique in this particular topic. So my questions after reading this paper are really around the fundamental ideas that the paper focused on. First of all, we know this focus really is about the cross-border banking operation in relation to systematic risk and contagion, etc. So what I'm wondering is there are cross-border operations and the linkage. We would expect there could be shocks to one bank, as for example, parenting banks in one country. Then there could if we see there's contagion, then maybe there will be spillover to banks or subsidiaries in another country in the region. But what I would like to see more in this paper or in this research is maybe provide more information to tell other researchers, for example, fundamentally, how banks and their subsidiaries work and being regulated in the interbank market, because this is very important to allow us to tell what is the mechanism for the potential contagion or risk spillover to happen. If they are subject to the host country regulations and interact with other banks in the host country in the interbank market, then how does their cross-border operation really affect their interbank exposure in the host country? Meaning, where is this cross-border operation directly affect their exposure? So the focus really is on exposure in the interbank market rather than more of a fundamental economic aspects. So I think it would be really interesting to have a direct test of the channel for the interbank cross-border operation on contagion. That's the fundamental. Well, that's the most important or interesting question that I would really like to see more in the paper. And Then when getting to the later part of the paper says that the regional interbank market is non-existent, while data on cross-border lending among subsidiaries or other banks is scanty. So because of that, the paper used the correlation in interbank lending to examine the lending relationship. I think this is something that everybody working on probably the markets in a developing country or at the early stage of development can appreciate the difficulty of getting sufficient information or data to research on the question. I think it's very useful that the paper went into the fundamental side of the economy, try to understand the contagion issue or the systematic risk. But again, back to this this fundamental question here, the research question here is the interbank exposure. So the correlation could be due to similar economic fundamentals and the banking structure, meaning due to similarity rather than links or cross-border transmission channel. So I'm not very sure using correlation here could give us enough information about what this research question really looking at. So if again there could be more direct test on the causality, for instance, causality of say the movement in the bank value or risk in one country, say due to panic or default events in their parent banks, does that cause the risk change or value change of their subsidiaries in another bank? If there could be some direct test on that, I think that would provide more direct evidence on contagion spreading. So these are the main questions that I would like to point out. And there are some minor questions that I think could be also interesting addressed in the paper. For instance, I agree with one of the comments mentioned early on. The bank-specific or country-specific settings could be very interesting and need further exploration. For instance, the paper mentioned the tenor ranges from overnight to 14 to 30 days. The difference in the interbank maturity could have very different implication to contagion, and that may worth further investigation. And also this very interesting new method using machine learning. I think I would like to know more detail explained in the paper. For instance, what is the size of the training data, and how is the output using this particular method is more superior compared to the more standard method. Another two minor thing is the paper rely on the dependent variable ES to measure the systematic risk, which is calculated based on VAR. But then there were some problems pointed out about VAR in the paper. So that makes me wonder if VAR had an issue, but then the dependent variable used in this paper relied on VAR, then does that make the dependent variable here also problematic? Is there any other robustness check or alternative measure could be used? And lastly, because again, interbank market is the key focus here. In the regression, the liquidity in the interbank market was measured by the interbank interest rate. So I'm just wondering, what about volume? Looking at the transaction volume directly, rather than just the price in the interbank market, would that give also important measure or information about liquidity? So I think the paper is very important and interesting, and also there are still a lot of interesting ideas and questions can be explored. That's all. Thank you, Victor.
Thank you very much. Constructive comments, in particular on the methodology issues, both on the use of machine learning, direct volume pricing. Thank you very much, much appreciated. We are running out of time, so I'll try to constrain maybe Esmie, Sherillyn, and Anosi to a very couple of points so we can end in time. So Esmie, you're on the floor.
Thank you so much, Chair. I also join the rest of the speakers to congratulate the authors. It's really an interesting paper with good statistics, high quality data, and indeed it has a lot of potential to produce more papers. I'll just quickly point those points which haven't been touched by the previous speakers. First of all, in order to improve the paper, I think the link between interbank market and the asset and liability part of the center of the commercial banks has to be explained precisely. In other ways, how does the structure of interbank market affect the structure of assets and liabilities of banks? This has to come clear in the paper. And going forward, I also think that it could be helpful if the authors could shed more light on the similarities and differences in terms of regulation, monetary policy frameworks, as well as collateral issues in the 5 markets, and then how these similarities and differences affect interbank trading, both at domestic level and also cross-border wise. And this would give a picture of what are the opportunities and challenges of doing cross-border interbank trading, which also can give a picture of what's the possibility of having an active regional interbank market. In addition to that, on the methodology, equation 3, the authors are using interbank market rate to proxy for banking sector liquidity conditions. Yibai has already said that maybe they could also use volumes. Yeah, but even using interbank market rate as a price as it is, I think it would be problematic in the sense that to a certain extent, the interbank market rate also mimic the monetary policy rate, because in most markets, there's a tendency to try to put the interbank market rate close to the policy rate. So as time goes, as the monetary policy rate changes, the interbank market also will change. So I would suggest maybe other than using the interbank market rate, maybe they would use the spread between the interbank market rate and the monetary policy rate to proxy for liquidity conditions in the market. Now, coming to the question put forward by captors, then what can we do? Say there are so many initiatives to try to deepen the interbank market. What can we do? And thank you to Patrick, the Director of Research at Rwanda Central Bank, for what you're doing. I've learned a lot from that. I just want to also to add something to explore. There's some initiatives which are being carried out by Fland Clear. They're providing guarantees in interbank markets. And maybe that's also one of the things that different markets can explore. And just last week, there's a paper published by Fland Clear that I have produced. I've developed interbank market indicators. So I've developed about 9 indicators of interbank market that show the level of riskiness of specific interbank markets. So it would be also good to explore that and the level of perceived risk in different interbank markets and how they can be mitigated. So I'll stop at this level. Thank you.
You're on mute.
Victor, you are muted.
Thank you very much, Esmie, for a very clear intervention and also for mentioning the work with the Front Career. Much appreciated. Okay, Sherillyn Raga, Senior Research Officer, ODI London. Sherillyn, you're on the floor.
Yeah, thank you, Victor. So again, congratulations to the author for this insightful paper. And there are, I think the central issue that they discuss is on the more persistent market segmentation, and in turn how this shapes bank balance sheet structure and contagion risk in the interbank markets. So there's a lot to unpack around these issues, but in the interest of time, let me focus on 3 main policy implications that comes to mind when I read the paper. So first, I think is the need for a balancing act between policy objectives of containing financial risk and financial inclusion. So the paper highlights, for instance, that in Kenya, there are lots of intermediary banks that improve the distribution of liquidity in the system. But from the financial inclusion side, of course, this gives a greater number of banks more room to create lending in the real economy. And this is this has development impact if they lend to transformative sectors like ICT, trade, or SME value chains. So we are focused on the contagion risk, but also I'd like to highlight some of the existing studies that interbank markets are not solely about contagion risk. For instance, the paper by Prof. Murinde and others suggests that the interbank markets can have a peer monitoring role in terms of monitoring counterparty risk, and this can serve as early warning signs for banking regulators. And by Esmie, where they find that the interbank rates influence the improvement of bank capitalization later on. So there's a need to balance financial stability and inclusion as we do our policy intervention, which leads me to my second point. And because of the persistent market segmentation, we need to tailor the policy. And that's why I think we should require more from banks that are too big and too connected to fail. So this is where both micro and macro prudential supervision comes in. So Peter mentioned that we don't have cross-border lending data. So can we ask central banks in the region on whether there's a room for us to establish home host country supervision? For instance, so we can monitor consolidated data of banks, banks headquarters and their subsidiaries. For instance, in Nigeria, they have memorandum of understanding with the rest of regulators in West Africa. So can Central Bank of Kenya potentially lead this coordinating role among EAC regulators, given the increasing assets and number of subsidiaries of Kenyan banks in EAC? So another question is whether regulators have access to high-frequency data. And then, can we assign relatively higher capital and liquidity buffers to larger banks in proportion to their systemic importance? So this will be addressed if we have coordination and also targeted regulation for core banks that are actually the likely sources of financial contagion risk. So this also so that's my second point. And then maybe my third final point is a little bit of a step back from our financial contagion risk discussion. And that is we should always pursue to develop and deepen interbank markets, because this will likely strengthen the resiliency of the interbank market itself and also at the banking sector system in general. So for instance, among the discussion and the points raised by our discussants, it all boils down to persistent market segmentation, the lack of competition. So we would like to direct our deepening of the interbanking market by widening participation. So some banks, for instance, we know that hold more liquidity than above statutory requirements, or only transacts with banks of similar size or ownership in the interbank market. And these are all rooted in the lack of information on counterparty risk. So I think pushing for enhancing information disclosure will go a long way. And then the other area too is also to do complementary development in other financial collateral markets. For instance, in the experience of Thailand, I just like to share, no, when they're starting their capital market development, they first developed the government securities market, and then this triggered collateralized instrument to the wider interbank and financial market segments. So this sequence also initiative can also play a role, and then we can all progress to developing interbank instruments in terms of by different tenors, both in local and foreign currency, and then maybe we can further on encourage market-driven guarantee schemes, improving infrastructures, like the effort if Central Bank of Rwanda. So all this tailoring of regulations and facilities, I think, can um, help us push the discussion based on the finding from contagion to actually developing and increasing the resilience overall. Thank you, Victor.
Thank you very much, Sherillyn. Very good points. In particular, this point of sequencing, I think, is an important policy question. So, Anosi Ikimimalo, you have 2 minutes.
Thank you very much, Victor. And this paper was actually I found it very interesting. I have a few comments. I'll try to keep it very brief. First, I think the method used, the machine learning technique, is innovative. Although the paper didn't explain a little bit more, or the paper could explain a little bit more how this technique is used. Some observations I made, for instance, of how although the Kenyan interbank market, or the Kenyan economy has a larger interbank market, you actually see more frequent trades in more regular transactions in countries like Tanzania and Burundi. I think that was quite an interesting observation there. One major finding, or one major point that the paper makes, is about how Kenya serves as a major linkage for cross-border interbank linkages. I think I echo a little bit of what Dr. Yeba said about whether correlation in terms of balance sheet is a way to go, because I mean, if Kenya has a larger market compared to the others, it may be intuitive that that correlation may be driven just by the sheer size of it. But I think the direction of the paper is very interesting. I think it's the direction in which interbank research now should go. And I know that the paper distinguishes between Pan-African Pan-African Kenyan banks, Pan-African Nigerian, and Pan-African South African. And so in looking at these cross-border linkages, perhaps it may be interesting to see what the impact of shocks to the parent banks. Okay, so Pan-African banks, how these, although the study limits to just the region, but given that the Pan-African banks are playing a major role in elevating systemic risk, perhaps there are some linkages that come from the parent banks, because typically the parent banks are much larger than their subsidiaries who are operating in these other economies. Although those subsidiaries may be larger in terms of the economy, or in that economy, so to say. So I think those are my main comments. Just to keep it brief. I have some other comments, but I would definitely want to send an email and have a chat later.
Thanks, Anosi, and you can share those directly with the Peter and Captas. And for going straight to the point, I think the point you mentioned about machine learning is very important. There are aspects of this paper, at least in extension, looking at, say, microstructure issues, which could be done much more effectively with the machine learning. But we're talking now about another paper, which is like it from here. So we only have about 3-4 minutes remaining. Maybe let me ask the audience to see if you have very quick, short intervention, just short intervention, 1 minute you'd like to make on this paper. please put up your hand. I don't see any hands now. There is a hand sign on top. Just click on the hand sign and ask any question. Yes, Grace.
Yeah, I just thank you so much, Victor. Very interesting paper indeed. And I'm actually based in Nairobi. I would like to have an opportunity to have a bilateral discussion with the team so that we can better understand the findings and how we as development practitioners can take up some of the findings and recommendations. And just follow up on that, he mentioned the East Africa Payment Systems Project, which we actually sponsor. So I'm a bit challenged because we've done a lot of work in terms of providing the necessary infrastructure, looking at the harmonization of rules and regulations, but still the volumes across borders are still very low. So my question is, what can we do to get these countries utilize what we put in place? And that, as I listened to the various discussants, my point was, why is there no interbank market across the region? And I was thinking, is it because there's no harmonizations of the rules of the game? Is there a risk coming from the fact that data is not equally shared? There is no ratings, the assessment of risks from the different banks. Is there anything that can be done? For me, based on the lesson of learned, I'm kind of in a fix. How do we address that? I also think that maybe the central banks can learn. I know during the COVID challenges, there were a lot of relaxation in terms of liquidity management and buffer requirements. Is there something they can utilize going forward? What were the lessons learned that can be actually applied going forward? It was a shock, yes, but they actually were able to relax some regulations and they've managed. Is it something they can carry forward? So I have a lot of questions, but I think I would prefer to have a bilateral discussion with the team and see what we can utilize in designing other interventions going forward. Thank you so much. So I look forward to, I hope you can share the contacts of the individuals. I deal with the central bank, but I've never dealt with these two tasks. Thank you.
Absolutely. Thanks very much, Grace, for coming in. I knew you would be interested from the practitioner side of the African Development Bank, and we are working in the same area. So definitely we shall, make you connect, and the questions you raise are very important for the co-authors, for Peter, for Anne, Captas, and also for Samuel. So thanks very much, Grace, for your intervention. Now, I have just say 1 minute to Dr. Thomas Wiri, who has played an important role in supporting the structure of this paper as a previous discussant as well. And then Jeffrey, also 1 minute. So let me start with you, Thomas, and then go to Jeffrey. And then we can close.
Oh, thank you, Victor. I will not spend even a minute, but just to say that I concur with everything that has been said. Initially, Peter had confused me with a lot of machine learning things that I hadn't picked up. And I thought by being on this platform, all these bugs would be sorted. And I'm extremely excited that this has been the case. So to Peter, congrats on the paper. And we hope that we can work at the end and have a very, very nice output out of all this effort. And Victor, thank you for giving us the platform.
Thank you very much. This paper will definitely end up in a top journal in our profession, as well as producing a lot of policy response for Central Bank and the region. Jeffrey, 1 minute and we close.
Okay, thank you, Victor. My point is on information asymmetry. I have seen a few papers where information problem or information asymmetry cause a serious moral hazard problem in the interbank market. So, and one of the problems they have because interbank studies usually focus on one country. Since this one is a cross-border country, I was wondering if it's possible to have some sort of a cross-border information sharing system like what they're trying to build in the European Union. For the interest of time, I think I'll leave it there. Just tip that in. I might send an email to the author with some of the papers I have on recommendations. Thank you.
Thank you very much. And I think you should, Jeffrey, send them an email. Jeffrey is developing some complex models of great information sharing systems across the world. And I think that this work could be extended in that direction, great information sharing in the interbank market. So we have run out of time. We are 2 minutes over time. But maybe I should just, before just close, ask one of the authors who wants to go first, just one intervention from the authors, whether it's you, Peter, or Sam, or Capitas, or Anne, just to close the discussion. Just 1 minute to give a vote of thanks, and then we close. Who wants to go?
Anne, can you go if you have?
Go ahead. Go ahead. Anne. Yeah, go ahead.
We are very grateful for the many comments. I'm speaking.
Yes, go ahead. Go ahead.
Yeah, I'm saying we are grateful for the many comments that we have had from the various discussions. Very interesting comments and very interesting interventions in terms of the way forward. But more so is the issue of integration in the ESC and cross-border interbank markets, which we need to develop. In short, is the issue of giving guarantee. If we can get guarantees, then banks can trade across borders. But yeah, these are the things that you're going to discuss and you're going to work on them. And we're going to address all the comments. We are just grateful for that. Thank you.
Yeah, thank you indeed. I think this is a positive way to end from Dr. Anne Kamau, co-author on this paper and Central Bank of Kenya. So I really want to thank the authors, Peter Wamalwa, Capitas Chilonga, Samuel Chiliongo, Anne Kamau, for really focusing and bringing the first ever paper that tries to focus on the East African region and paving the way. As you can see, I think this is just the start of a very interesting project, which can be very well funded and which can produce numerous papers, whether you want to take an extension into machine learning, whether you want to go into regulation, whether into payment system, as Grace was mentioning. There is a lot you can do here. And thanks for trading this brief. And thank you all for your generous comments from Adam, from Patrick, from Esmie, from Sherillyn, and Anosi, and from Yi. Thanks so much. And from you, the audience, if you have any questions, comments, please send them to Meng, who is here collaborating. Thanks indeed. And we look forward to seeing you again, next week. Thank you. Thank you. It's been a tremendous time. It was great time. And thank you indeed. Yeah, so I can.